Good morning, John. Well, the producer price index for final demand shows that companies are still paying a lot more money for their goods, and that is not good news overall for the inflation picture. The month-over-month change, 0.8%. That's up 0.2 from last month and 0.3 higher than the expectation, which leaves the year-over-year number. Wait a minute. Excuse me. I missed the calculation there. 9.6%, which is up from 8.6%, a full percentage point higher for PPI final demand goods. Take out food and energy, and that is the number that people want to do when they're not considering what's happening with energy prices. 6.9% a year-over-year basis. It's up 0.7%, way ahead of the October number of 0.4%. So we are seeing some significant increases in overall prices paid by companies for their factory-made goods. One note this morning, the NFIB Small Business Optimism Index came in a little bit stronger, a little bit better, but the prices charged number rose significantly. So we are seeing inflation still in the economy. It's not the T word.
A nudge lower in the equity market, not a big one, down 15 on the S&P, down 1/3%. And yields making a move, Lisa. But again, we were already there on 10s. Yields just a little bit higher, up a couple of basis points to 143, basically as you were on a 2-year, up 2 basis points to about 65.
It's compelling to me because how much is baked in and how much can companies continue to pass this along to consumers that have started to push back around the edges with respect to higher prices. And that really will be the question with respect to the consumer. But I am surprised that we're not getting more of a reaction, considering that this is a significant upside surprise at a time when inflation is one of the key concerns heading into 2022, John.
Mike McKee, walk us through the Fed for tomorrow. They've got the CPI data, they've got the labour market data, they've got the PPI data. Walk me through what you're looking for tomorrow.
Well, I think a lot of people are, first thing you want to know is how fast are they going to taper? And the expectation is they double it. So if we get that $30 billion a month number, move on quickly from that to what are they forecasting for inflation? Remember, these guys have anticipated for the last couple of years that inflation would fall back to about 2% in the 2 or 3 year time period. Do they raise that given what's happening? And then everybody's going to want to look at the dot plot, get an idea of how fast the Fed thinks they need to raise interest rates and how far. That'll tell us something about when they might be looking to do that.